Hi, everybody. It's Robert Klein from Virtuso Capital. So today we're going to go through construction and rental building analysis. So before I do that, I'm going to go through the BCSC disclaimer. This report contains statements related to future business and financial performance and future events or developments that may constitute forward-looking statements. The information, calculation, and data presented are not guaranteed or warranted and may change as the project matures and advances through the design, construction, and operations phases. The information presented herein shall not be considered as a substitution for legal, accounting, or other professional advice. Please seek appropriate legal, tax, and investing advice before you're making any investment decisions. So, who is this presentation for? I'm going to say it's going to be for real estate investors. So what will you learn? Where is the profit in constructing and owning a rental building long-term? And what's the story of myself and Rick Genovese getting involved into projects like this? So quick background on myself. Been a residential mortgage broker since 2009, a commercial mortgage broker since 2016, and my core clientele has always been real estate investors and business owners. And what that pretty much means is that I deal with the difficult side of financing all day long. It even actually got to the point that I made a video called How to Qualify for Millions Worth of Mortgages in Canada, where the first half is on the math of residential financing, and the second half is on the math of commercial financing. And I would say this, if you are a real estate investor, this video is an absolute must watch. And if you want to get to it, all you got to go do is YouTube, type in Millions Mortgage Canada, and it'll pop up right away. And on top of that, this video will actually give you a good introduction to who I am relative to mortgage financing. How did this adventure start? Well, this venture started really when I moved my family from Langley to Mill Bay in March of 2018. So why would I move my family from the Lower Mainland to Vancouver Island? The short answer is this. You can actually buy $1 million house for $1 million on Vancouver Island. And that's very difficult to do in Vancouver. On top of that, like the place that we ended up getting was 2 minutes from the ocean, 10 minutes from a lake. It's quiet and beautiful. I got 2 small kids and I'm a mortgage broker, so I can pretty much work from anywhere. On top of that, I wanted to scale into real estate and I wanted to live in an area where scale exists, and scale exists on Vancouver Island. And the reason it exists is lots of areas trade above a 5% cap rate. And that means maximum financing. So from this point of view, when I moved to Vancouver Island, I had to figure out really 2 things. 1, where do I buy? And second, what do I buy? So properties like this came up all the time. 18 unit in Campbell River, BC, 1.6 million, 5.5% cap rate. Rents were below market, so I could turn out the tenants or turn out the units and increase the rent and increase the value of the property. 25% down was required and it was cash flow positive. But here was my challenge. Why Campbell River? And I couldn't answer that. The next property that came up that I was interested in was an 8-unit commercial in Shawnigan Lake. 1.5 million, 6% cap rate. Rents were close to market, 25% down, cash flow positive. But the question was, again, why Shawnigan Lake? And I couldn't answer that. So why is the where so important to me? Well, in 2008, 2009, I bought, sold, flipped 17 properties in Winnipeg under the pretense of cash flow only. Tenant profiles turned out to be a disaster. They pretty much destroyed the properties themselves. There was no cash flow. From beginning to end, it took 5 years to get out of there. I broke even, and a few million would have been made if I picked the correct area to begin with. Literally, if I bought a 1-bedroom condo in Vancouver in 2009, I would have done substantially better than what I did in Winnipeg. So how did I figure out the where? Don Campbell is the short answer. Well, he's actually a real estate investor and he's an economist. I wouldn't actually know. He's the closest to as an economist you can get without being an economist. He's built the real estate investment network from the 1990s to the 2000s to the mid-2000 teens. He's written 10 plus books on real estate investing in Canada, the main one being Secrets of the Canadian Real Estate Cycle. The real estate cycle defines the when and where you should be buying property. And on top of that, they make it really easy. Across Canada, for every province, they create top 10 lists of cities to invest in. So my objective was this. out of the top 10 cities, which is actually closest to me, and then I'll invest into that one. So the top 10 list at that time was Surrey, Abbotsford, New Westminster. Number 4 was Victoria, Kamloops, Kelowna, Chilliwack, Tri-Cities, Burnaby, and Vancouver. Number 4 was Victoria, which was 30 minutes away, which pretty much defined the area that I was going to invest into. Next question was this: what do I invest into? As I mentioned before, my objective is scale. True scale only exists in commercial. It does not exist in residential. You can thank the Canadian government for that one. On top of that, for commercial, you have to be buying at a 5% cap rate plus to get access to maximum financing. The second requirement that I have is forced appreciation. So what does that mean? I got to be able to increase the value of the property without market influences. So for example, here's the property value equation of all commercial property. Income minus expenses of the property divided by the cap rate. So when you look at cap rate, pretty much what that is what that property type trades at in that market. That is influenced by what the market's at. Income minus expense is not influenced by the market. So if I can actually increase the income of a commercial property or decrease the expenses, I know I can actually appreciate the value of the property. The third requirement that I have is speed of money. How fast could I put my money in and get it all out and still own the property, then buy another and another and another? So in paragraph format, pretty much what I wanted to invest into was commercial properties that I can increase in value within a year or two through forced appreciation, which allows me to refinance and get all of the money out so I can buy another and scale. So how did I start approaching that problem? Well, the first step for me was really networking. I went out to Victoria Real Estate Investors Meetup and the Reinvestors Group, two excellent groups on meetup.com that you get access to. So I went there for about 7 to 8 months, and I ended up having a conversation. I believe it was December of 2018. It was like a 4-minute conversation, and I met a successful business owner who had built 3 small purpose-built rentals for a total of 100 doors, and he was able to keep them as rentals. He was in the process of building another 100 doors. His first building was a 20+ unit on a 7,000 square foot lot, and he had no background in construction or development. So what blew me away by this conversation, his first building was 20+ units on a 7,000 square foot lot. What that means is he bought a house and put up a small apartment building on it. And I come from Vancouver. That does not happen. And on top of that, he has no background in construction or development. So for the first time ever in my life, from this 4-minute conversation, I thought to myself, oh, maybe this is possible. And at the same time, it seems reasonable. See, I come from the perspective of Vancouver. I call this a Vancouver bias for development. I have a friend of mine who built 190 units for $40 million. Another friend of mine who sells $30 million to $125 million development lands to the largest developers in the Lower Mainland. And there's endless land assemblies for $15 million. So based on this, I'm assuming that I'm not going to be invited to the table for anything like this. So I started doing tours all around Greater Victoria, and I pretty much went out there and just saw what was getting built. And I came across properties like this. So this is that 20-unit building that the gentleman that I met built and owned. And when I saw this, the first thing I did was get in contact with Rick Genovese. So Rick Genovese has construction and development for 30+ years, owns 80+ stores in Ontario, and he's been actively searching for projects to build in Surrey, BC. So I call him up and I go, hey, Rick, you got to come out to Victoria. You have to see what's going on out here. It's nothing like I've ever seen. So Rick comes out the next day, and within a week, we had a meeting with city planners. Rick stopped everything he was doing in Surrey. We found an excellent realtor to work with. Realtor actually knocked on 60+ houses, and the area we picked had its official community plan changed to medium and high density 3 days before we started. So within a couple of months, we had 6 lots under contract worth about $4 million. And here are those 6. And the first building we're going to be putting together were these 2 lots side by side with 14,485 square foot. So now that we have the land, the next steps where we had to build the team and build the financial model for the building. We will go actually into significantly more detail on our team when we actually do one-on-one investor presentations, but we will list out our team right now, and we'll discuss some of the challenges we had building our team. For our rezoning consultants, we're using Key Corp Developments. Our builder is DMP Construction. Our architect is Nick Bray Architecture. Civil engineering, One Point Engineering. Geotech engineering is Brimmel Engineering of Richard Brimmel. Mechanical engineering is going to be Avalon Mechanical Consultants. Triumph Electrical Consulting for electrical. Structural engineering will be Sorensen Trilogy. And Wittech Environmental Services for the environmentals. Commercial appraisals, Baker & Osland. BFL Canada for insurance. Pemberton Homes for property management. Career Consulting for construction and contract legal risk management. Corporate lawyer, Kickstart Law with Don Deans. Accountants, DJ Resnick, David Resnick and Associates. Trust company for RSPs and TFSAs, Western Pacific Trust. And Coastal Community Van City for our residential loans. Construction loan will be through Coastal Community Credit Union. RBC is CMHC Insured Loans and Royal Bank. So those are just a list of, I would say, 85% of our team. The other 15% is being built right now. The challenges. So we had three main challenges that we had to solve. Three of them were this: rezoning consultants, builder, and architect. What is a rezoning consultant? So they are masters at taking projects through the city. So they will actually rezone the property for you, get you your development permit, and get you a building permit. The challenge we had when we tried to do this ourselves is we were getting a lot of pushback from the city and almost felt like we didn't know what we didn't know. And it took about 5 or 6 months into this process that we ended up finding out a group that actually would do this on our behalf. So we hired them immediately, and that solved that problem. Next challenge we had was a builder. So there's two main challenges when you're working with a builder. You have to have a builder that has the capacity to take on your build. And second, they have to specialize in what you want to build. So when me and Rick first came out to Victoria, we sat down with 10 to 12 different builders. And out of that, 2 to 3 of them actually they actually specialized in the building type that we wanted to work on. But all of those builders were at full capacity. They could not take on our deal for 2 or 3 or 4 years down the road. So we ended up starting to work with a builder that didn't specialize in our building, and the costs were 40% more than what they actually should have been. And what ended up happening, just through networking and just getting referrals, we ended up finding a builder probably about 10 months down the road when we're going through the whole rezoning process that actually specialized in our build and had the capacity to take us on for our project. The third issue was architects. So when we first came out to Victoria again, we probably interviewed 8 to 10 different architects. And the challenge that we had was the price. What are we building? Are we building like a condo rental build, or are we designing the Taj Mahal? So it took about 8 to 10 months to actually find the correct architect who actually specializes in this building and has the capacity to take us on. So at the end of the game, we end up having an excellent architect that is fairly priced. So those are the three components that we really had challenges on. And it really took about 1 year to build the correct team. Keyword there is correct. And now that the correct team is built, we will be able to apply this team to multiple builds in the future. So let's go into the financial model. The traditional process of developing a property goes something like this. You buy land, you get an architect involved to draw a bunch of drawings, go through the rezoning, get development permit, building permit, you contract out a builder, and then you go to the bank. There's two fundamental problems with this that I personally see. One is with the architect, and second was with the bank. So the problem with the architect is the architect dictates the financial model. What do I mean by that? Based on what the architect draws, produces a financial model. In my opinion, this is not a good approach. You should actually have a financial model built that dictates to the architect what to actually draw. The second issue that I found was the banks. So you go buy land, you hire an architect, you go through all this rezoning, development permits, building permits, and you contract a builder. In this process, you have spent millions. Then you go to the bank and you say, hey, bank, go give me that $10 million loan. And the thing is, you most likely don't know why that bank would give you that $10 million loan in the first place. And the challenge with that is your numbers or your experience or what they want to see as check marks could be wrong. So you can go in there and they can say, I want 10 million. And they're like, no, we can only give you 7 million. And that creates a problem. Or I've seen this where they actually just deny the entire project because the whole thing, the risk profile, what they want to see is not there. So for us, how we resolved this was we put the bank in first place. We want to look at it in terms of a banking point of view. Then we buy the land, then we get the architect involved, then we go through rezoning, and then we go through the builder. And if you actually take it to one more step further, what we really want to do is have a financial model that dictates the bank, that deals with the purchase of the land, the architect, the rezoning, development permit, and building permit, and then deal with the builder. So let's get into the financial models. What is our financial models? Myself and Rick sat down with a blank Excel sheet. And our first entry was land price, $1.24 million. Took about a month, but we were able to build the overall cost, the basic cash flows to give us a good understanding of what we should be doing. And then it took about 3 to 4 months to actually build a model where we're able to integrate the cost of the building with a financial model to keep the building. And of all these tabs, we probably use, say, 6 or 7 tabs to map out that whole process. And the question then becomes, well, how do we optimize a building? Well, how you optimize anything really is this: define the objective to be maximized and then add variables and constraints and go from there. So for us, what is our objective when we look at this building? Our objective is this: maximize profit, obviously, value of building minus cost of building. We want to maximize our profit margin, value of building divided by cost of building. So what does that mean? If I can build a building for $10 million and it's worth 14 million, my margin is 40%. If I can build a building for 20 million and it's worth 24 million, my margin now is 20%. So I'd rather build a $10 million building to get that same profit. So the profit margin is larger. On top of that, we really want to maximize the tenant profile because our objective is to own these properties long run. So these are the 3 core objectives. So the first limitation we have to deal with is the land size. So our lot is 14,485 square foot total. So when you look at the main limitations of any building, you're going to have something called the floor square ratio, which is basically the building size you're allowed to build. So what that means is if you have a lot of 14,485 square foot and your floor square ratio is 2 or 2.0, you can build a building that's like 29,000 square foot in total. So floor square ratio. The second limitation that usually comes out is number of floors. Like how high can you go up in that area? Is it 3 floors, 4 floors, 10 floors, etc.? And then the next restriction is number of parking spots required per unit. When we actually look at where we are, what's interesting is there is no floor square ratio limitation, really. And then also there's no number of floors. They actually want you to build as big as you can get. But of course, there's a financial limitation to that in itself. So the real limiter for us was just the number of parking spots required per unit. So when we look at parking layout, you have a couple of options. For us, we can actually go above grade parking, and we can pretty much go down 2 levels below. And so for our first project being in Langford or in Victoria, we decided to only do 1 level above grade ground parking. And the reason is that the ramp took too much space to go down. And because of our size, you get into a law of diminishing returns. If we go down, the ramp took up so many spots that there was no point. So we just built 1 level above. And on top of that, the cost of underground parking is much more expensive than above ground parking. And we look at the layout, we were able to put 40 parking spots for our building. So what are the parking spots required? Well, if we build a bachelor unit, we need 1.25 parking spots per unit. For a 1-bedroom, we need 1.25 parking spots per unit. For a 2-bedroom, we need 1.25 parking spots per unit. And for a 3-bedroom, we need 2 parking spots per unit. So these are the restrictions. What I like to do is I like to apply infinities and zeros to any idea that I think, because it ends up defining if what I'm thinking is really true or not. And I like looking at maximums and minimums. My logic process, what we want to apply this to is what type of units should we build? One of the options is small units. One of the logic things that are out there in the development world, the smaller the unit, the more revenue per foot you will get. So if you had 32 units and you built 300 square foot bachelor pads, the revenue per foot is extremely high. The only problem is the total revenue is extremely low. And guess what? When you apply that to fixed costs, it doesn't work. But let's now go to the giant units. So we built 20 units, 2,000 square foot, 4 bedrooms. Okay, so here's the problems. No one in the market will rent this for the correct price. You get into the law of diminishing returns, and there's really a maximum amount of rent a unit type will get regardless of size. So let's look at our building considerations. First of all, we know there's no size restrictions. There's no number of floor restrictions. We have parking restrictions. We want to maximize revenue per foot. We want to maximize total revenue. We want to maximize profit margin. We want to maximize profit equals value minus the cost of the building. This is what we want to optimize. And we end up putting this thing into our models. What ended up coming out was this: 32 2-bedroom, 1,000 square foot plus units, 4 levels of residential with 8 units per floor, 1 level above grade parking, 1 rooftop patio, and 1 small basement for storage. This was the optimized formula. Let's talk about profit margin. The profit margin on this building based on 1,000 square foot units is 32%. It's actually quite excellent. Now, if we actually drop this to 800 square foot, the profit margin goes down to 17%. If we did 1 bedrooms, 600 square foot 1 bedrooms, 32 of them, it goes to negative 1% profit margin. And if we did 32 bachelor pads for 400 square foot, we're at negative 21% profit margin. So based on this is what we're going to be building. Now we're going to get into the math of commercial buildings. So when we look at the math of commercial buildings, this applies to office space, industrial space, retail space, self-storage, residential. The math is pretty much all of the same. So here's the valuation equation. Value equals net operating income divided by capitalization rate. So what's net operating income? That means income minus expense before mortgages. We're not going to include any mortgage payments, just pure income minus expense of the property, nothing to do with financing. Then you want to divide it by the capitalization rate, which is pretty much what that property trades at in that area. So for us, we're at about 4.5%. That's the high side. Appraisals are around 4%. They're being purchased right now around 4.25. So we're on the high side for what capitalization rate we are using. Here's the magic question. If we increase the rent by 1 cent per square foot per month, how much does the building go up in value? I want to increase the rent by a single penny. So we know we have 32 1,000 square foot 2 bedrooms. We're going to probably on average, if we rent out the whole thing correctly, it's $2.20 per square foot or $2,200 a month per unit. If we go from $220 per foot to $221 per foot, we're now at $2,210 a month per unit. So the difference is $10 a month in rent per unit. So not that significant, okay? So if we look at the cash flow gain, that's $10 a month times 12 months times 32 units, and that's a cash flow gain of $3,800 a year, and that's great. But it doesn't end there. The value equals net operating income divided by capitalization rate, right? So what's value? Equals income minus expense divided by capitalization rate. Value equals income minus expense divided by 4.5%. So what did we end up doing with that $3,800? We increased the income by $3,840. So value equals $3,840 divided by 4.5%. We just increased the value of the building by $85,000 by increasing the rent by a penny. So every penny per square foot of rent increase is worth 85 grand. To me, that's quite magical. Every 10 cents per square foot of rent increase is worth $850,000. We are in the business of pennies. Our objective is to optimize everything we possibly can from every possible angle. And so what else? The question then becomes, what else are we optimizing? So that's a good question. So here's an example: rental grade or condo grade. Left side is condo, or left side is rental, and the right side obviously is condo. So let's go through some rental grade examples. So here's actually pictures from the area around us. The other rental buildings are looking like this. So this is an older building. That's rental grade. That's rental grade. That's rental grade. And this is condo grade. and this is condo grade. So the question is, if we invest into condo grade furnishings, can we get 15 cents per foot more? And the answer when we deal with our property manager is yes. That basically means, can we get the rent increased by like 7%? So we take 1,000 square foot, times it by 15 cents, times 12 months, times 32 units, basically means our revenue per year is up $57,600 a year. Apply the value, 57,600 divided by 4.5% to that equation. The value by doing this is 1.28 million. The question is now, what is the cost? Well, it costs about $10,000 per unit for the upgrade. So that's 32 units times 10,000. So that's $320,000 in upgrades. So the profit is 1.28 million minus 320, gives us a profit margin of 960 for doing that. So in that scenario, obviously we're going to do that. But more importantly, not more importantly, but on top of that, we get a higher end tenant. We get to pick the cream of the crop. It also creates a much better culture environment in the building, because our objective here is to own it long run. So the next thing we want to look at is rooftop patios. So rooftop patio, what we're putting in here is a 1,770 square foot of enclosed place, and then 2,200 square foot of outdoor space. So the question is it worth it? Well, the cost of that is about $150,000. So what I'm going to do is I'm going to put this into this equation and figure out how much does this cost us per foot for revenue. So $150,000 equals revenue per square foot times 12 months times 32 square foot divided by 4.5% cap rate. So turn the math around. We got $150,000 divided by 12 months divided by 32,000 times 4.5%. Revenue per square foot is 1.8 cents per foot. So we need to get 1.8 cents in revenue per square foot to break even. Anything above that is profit to us. So in a 1,000 square foot unit, that's $18 a month per unit went towards the rooftop patio. So pretty much at this price, it's a negligible cost in order for us to attract the highest quality tenant possible. And if we were to resell as individual condos, this would be an excellent feature to have. So we're pretty much putting a rooftop patio on. So the next question is this: pet friendly. It creates a larger pool of tenants to choose from, attract a higher quality tenant that will pay more. And if there is a 10 cents per square foot gain in revenue and 40% of the building has pets, what is that? Well, the value is 10 cents per square foot per month times 12 months times 32,000 square foot divided by 4.5% times 40% of the building. So by allowing pets in there, there's about $340,000 gain. Well, the cost is about a $3,000 portable dog wash to take care of the dogs. So leasing up, here's another optimization process. Our objective for leasing our property is to obviously maximize rent. At the same time, we want the best tenant profile, right? We want someone treating our property correctly. We do not want what's on the right side of that picture. So how do we do this? Well, the short answer is time. Instead of leasing the entire building in 1 month and accepting whoever we can, we wait 3, 4, 5 months to lease the entire building, and we pick exactly who we want. Every penny in extra income is worth $85,000. Every dime in extra income is worth $850,000 for valuation. So it's worth waiting 3 to 4 months to lease to get exactly what we want. So this is exactly what real estate investment trusts do. Smaller developers, I find, don't do this as often, and that's because they're not that familiar with these formulas. More optimizations in process. Yes, we do. We have an optimization that will add 30 cents per foot to the building, and we will actually go into further optimizations actually during our investor presentations when we do one-on-one through Zoom. So optimizations overall. Maximum profit equals the accumulations of optimizations. We want 5% here, 2% there, 7% there, 6% here. And when you accumulate all that, it only adds to the bottom line. So the second step in the financial model is getting into investor returns. Overall investor ownership percentage will be 50%. If someone puts $100,000 in, they'll own approximately 1.6% of the project. That's during construction. It's the step one. We'll be putting $100,000 in. And once the building is built and we lease it up, we will go back to CMHC and get a loan to actually repay you your $100,000 and still allow you to keep the ownership or the equity in the property. What this means that the speed of money is extremely fast. It's probably within 2 years. So you get your 100 grand back on the first year and you still own it. So cash flow is 4,600. Principal pay down is 2,700, meaning that the mortgage gets paid down. And the equity growth from the initial bump in value from the cost of building it versus what it's worth is around 63,000. So in the first year, it's about $170,000 total. But the key being is you get your 100 grand back. So our objective actually with that is we get your 100 grand back, and then we have the next building for you to put that 100 grand into, and we scale this over and over and over. And we think over, realistically over a 10-year period, we could take that 100 grand and put it into 3 or 4 buildings over that time. So let's go to year 2. Cash flow, 4,300, principal pay down, 3,025, equity growth, 8,900, $16,000 total, $17,000 total in year 3, 17,000 in year 4, and it goes on and on. 18,000, 19,000, 20,000, 21,000, 22,000, 23,000. But again, the key being is that initial investment will be returned back, and you still be able to keep or retain ownership in the property for as long as we keep it. And I guess I'm going to recite those words again. Get 100% of initial investment return once the building is built and leased with a CMHC loan. Maintain full ownership of your shares for as long as we can keep the building, which allows you to participate in cash flow, mortgage pay down, and appreciation. Once your original investment is returned, we would provide the next opportunity to recycle those funds into the next building, and so on and so on. So how is all of this possible? Well, it really comes down to the financials of the building. Build cost overview. The cost of the building at this moment is $12.7 million. We have about $1 million contingency for that. Cost per square foot sellable is about $386. This cost would be even lower if we were selling this thing right away, but there's a bunch of costs that have to be incurred to keep it. 32 units, 1,030 square foot average. The cost per unit that we're building is $398 at this amount. So let's break down the construction costs here. So construction costs, hard costs, $8.49 million. That is the cost of all the materials and labor to actually build the building itself. Soft costs of $1.5 million. This is architecture, city fees, engineering fees, BC Hydro fees. It's actually an endless list of fees for soft costs. Land costs, $1.25 million. Financing is $926,000. That includes a $450,000 CMHC fee in order to get the CMHC loan. GST at $560,000. So total build cost is $12.7. So how it's going to work is we're going to get construction financing at 75% of the build to cost. So we got a loan for $9.5 million. The investor contribution will be for the other 25% for the 3.186 combined. Stage 2, return of investor capital. So once the building is built, we're going to go back to CMHC. So we're going to owe $9.5 million on the loan. There's going to be investors' monies of $3.186 million. So we're going to get a new loan for $12.7 million to pay out the construction loan and return the investors' money back. Stage 3, now we're going to own this building long run. So in year 1, if we look here, the value of the building is going to be around $16.7 million. We're going to have a mortgage of it around 12.5, which leaves a profit margin initially on this building around $4 million. So this is where most developers stop. They will build these buildings and sell them immediately. So we're not going to do that. And we're going to show you what happens when we don't. The gross revenue in the project is $967,000 when we keep it. The vacancy at 2% is $19,000. The gross effective revenue is $948,000. For brand new buildings like this and other buildings that we have actually looked at their financials, their expenses are around 20% of the effective gross revenue. If you're dealing with a much older building, like 30, 40, 50 years old, operating expenses can get up to 40%. So that means our net operating income is $754,000. Our mortgage payments, assuming 2.7% at a 40-year amortization, is $461,000, leaving us a net cash flow of $293,000. I'm going to assume that the rent increases by 3% per year, and I'm going to assume that our expenses are going to increase by 5% per year. So in year 4, our value of our building is $18.5 million, less outstanding loan of 11.9. So our equity portion right there for mortgage pay down increase in value is $6.5 million. But let's not forget, we've also produced cash flows in year 1, year 2, year 3, and year 4 of 290, 277, 303, and 330. So when you add those together, the overall profit margin is around 7.8 million. So in 4 years, we took profit margins of 4.1 million to 7.8 million. So now let's go further. Let's look at year 10. The value of the building now is 22 million. We have a mortgage of 10.6 million. So the equity from mortgage pay down and appreciation is 11.9 million. But at the same time, we've had these cash flows every year, 358, 387, 417, 448, 479, 512. Here is around approximately another 4 million worth of profit. So when you add 11.9 or 12 million plus the 4, you're at $16 million worth of profit. So most developers are selling for the 4, but in my opinion, they should be designing their models to keep it so they can get access to this, because all they have to do is really just manage a building to capture the rest of the profit. Here's sort of the summary. If we sold in year 1, profit is 4 to 5 million. If we keep it for 10 years, profit is 15 to 16 million. If we keep it for 20 years, the number is going to blow most people away because it blew me away. It's 35 million. Now I'm going to break this down logically to you. So here it is. Building value goes from 16 million to 32 million in 20 years. On an inflationary base, that's reasonable. So there's a $16 million gain there. Mortgage, 12.7 million gets paid down to 7.4 million over those 20 years. So that's a $5.3 million gain there. But what's actually very interesting is the cash flow. The cash flow is 13.7 million. You combine it all together, you're at 35 million. So cash flow, mortgage pay down, appreciation, all working together is an extremely profitable thing to be doing. Most developers are in the business of building and selling. We are in the business of building and keeping. Our objective is to build 30 of these buildings in the next 15 years and really keep them all under this model. So that's the financials of the building. So here's some quick renderings. These are the most recent ones that we have of the actual building itself. This is a corner view, the front side and the side view. Here's another more of a front side. Here is the rooftop patio, and then you can actually see the parking down here above grade. And then here's a back view of it, and there's all the parking there. So investor presentation. So during the investor presentation, myself and Rick with you, we'll go further into numbers. We'll discuss the 30 cents per square foot optimization. We'll review all the architect drawings, floor layouts, renderings, etc. We'll discuss all members of the team actually in detail, like architects, engineers, builders, legals, consultants, banks, etc. Go into the economics of the area that we're investing into. And we'll also discuss avenues to participate, RSPs, TFSAs, and cash. Answer any questions you may have, and meet myself and Rick and have an open dialogue conversation. In order to get in touch with us, just reply back to the email that you got this video from. I'm Robert Klein, robert@virtusocapitalventures.com, 778-896-6732, and Rick Genovese, rick@virtusocapitalventures.com at 604-603-0929. All right, so I think that is it, and I look forward to talking to you in the future.